I'm Isaac Barco from Openwork Mortgages. So we're going to talk about mortgage payment dates. Most borrowers focus on how much they pay each month, but when you pay can also change the cost of your mortgage. That's because most lenders charge interest daily. As a mortgage broker, I know all about this, so let's start with an example. In this instance, we have a balance of £200,000, interest rate of 4%, term of 20 years, repayment interest calculated daily mortgage. Now here's the key point, paying on the 1st of the month versus the 28th. Why does earlier save you money? Daily interest mortgages work exactly as they sound. Interest is charged on your balance every single day. If you make your payment earlier, you reduce your balance sooner. That means fewer days where interest accrues on a higher amount. Even though your contractual payment will see little difference when you pay in a month, over time you pay less total interest. In this example, £592 of extra interest is accrued before a payment is made. Let's break that down. So we have £200,000 times 0.04 to represent our 4% interest, divided by 365. That equals £21.92 per day. Now multiply that by 27 days between the 1st and the 28th. That's £591.84. Over years, those extra days of interest each month compound. That can add up to tens, hundreds, or even thousands in extra costs. By paying on the 1st, you start reducing your balance sooner, and that makes your money work harder. Now let's talk about direct debit secondary attempts. Most lenders let you pay by direct debit. If your first attempt fails, many lenders try again, but secondary attempts are collected later in the month. If your due date is already late in the month and the payment fails, the second attempt might fall into the next calendar month. That can cause your payment to be reported as missed. It can harm your credit score. It can lead to arrears or missed payment markers. If your due date is earlier in the month, there's more breathing room for a second attempt to still land in the same month. If your due date is later, be proactive. Make sure your payments are going through as they should. Now on to due date breaks. So some lenders offer a due date break. It's essentially a 1-month payment holiday. You skip that month's payment and resume the following month on the new due date. So this can help you move from paying later in the month to paying at the start of the month. But there are trade-offs. So you'll still be charged daily interest during the break. The skip payments added to your balance. You may pay interest on it for the rest of the term. That means the overall cost of borrowing can rise. Due date breaks can be useful for short-term cash flow issues, but see them as a temporary fix, not a cost-saving tool. So in terms of the key takeaways, when you pay matters, and it can save you interest. Direct debit timing can protect your credit. An earlier due date gives more room for a second attempt in the same month, and due date breaks can help you change your due date, but they can come at a cost. So that's mortgage payment dates overcome.